Good evening, ladies and gentlemen. Happy Saturday to you all. I hope you're having a wonderful start to your weekend. And boy, what a crazy week it has been. And the title of the video, The Trap is Set, the Grim Reaper Comes, is a reference to two things. So the first is this famous meme that I always post on the channel. Everyone that thought they bought the bottom of the market, the Fed is coming for you. And you guys can kind of figure out my skew of where I think the market is going based on this. And in the comment section, if you guys could, for one, if you thought the debt ceiling was going to get resolved this week, and two, if you didn't believe any of it, that politicians wouldn't be able to do anything right, as they always haven't, throw a 2 down in the comment section below. Let us know your thoughts. So getting into the video, let's just quickly go over any of the news that happened this week that could have generated the reaction the market had. So on Monday, we really didn't have anything. We had a lot of Fed speakers throughout the week speaking, and we just basically got, Monday was Fed speakers speaking a lot. On Tuesday, we had Redbook and then Bostic, along with core retail sales. Core retail sales coming below expectations on the year-over-year number, but they did come in better than on the month-over-month. So a mixed bag there of different things. We had industrial production come in as well, better than expected. It was expected to come in shrink. So, you know, you're getting mixed pieces of data. On Wednesday, we had the crude reports, which always come out on Wednesday. Home starts were actually very interesting, where building permits went down, but home starts went up. So it's kind of a mixed bag. Like, you're getting good and bad data through the week. And then on Thursday, we see that we got initial jobless claims coming in better than expected, along with Philly manufacturing index came in actually slightly still negative, but better than expected. So, you know, business isn't getting destroyed as much as possible, but, you know, still a negative number showing a shrinkage in the economy, which hasn't happened in a very long time. So job market still staying hot like all know tomorrow, and then existing home sales going down, along with the beating by a significant month on the month-over-month, meaning that the housing market may be cooling off, which is a good thing for the Fed because they want to see some of that shelter inflation kind of calm down. But again, they're still seeing stuff that they don't like. And then on Friday, we had Jerome Powell speaking, which we're going to cover a lot of what he said. Williams actually said he was not going to comment on the monetary policy, but he did actually make one statement that I would disagree with, that it's not a statement on monetary policy. He said the R rate, which is basically what the rate that is expected to happen once they finish their quantitative tightening cycle, would be higher than previously expected, meaning they're seeing that they don't want this type of inflation to come back, meaning they've basically generated a lot of growth in the economy, that they're going to have to keep rates not back to zero. So basically they're almost saying like, hey, your euphoric back to zero ideology is maybe not going to come back ever, like period ever. So we're going to have to see. Now, again, I don't believe that they're going to basically, when they start cutting rates, that something's going to break. They're going back to zero. That's just my personal opinion. But the thing that blew my mind, and absolutely blew my mind, especially with the move we had in the market, is the net speculative positions coming in at 388,000. Guys, this has not happened since the dot-com bubble. We have not been this short since dot-com 08. This is going back to before this metric was even created, where they started looking at this data. And basically, they are so short this market. So either a lot of smart people are really, really dumb, or some people know something that we don't, or the expectations. And here's the thing. When the debt ceiling talks fell through this week, guess what? Maybe they saw it coming, and the market basically took I want to say a nosedive, but common sense started hitting them on the last hour or two of the market on Friday. And again, this ginormous run that you're about to see was generated out of euphoria that the debt ceiling issue would be resolved. So you can clearly see here the S&P 500 just had an absolute tear. We on the S&P 500 tore up to the highs about 2.5% within 3 days of the expectation that debt ceiling was going to be resolved, that the Fed was going to cut rates and all this. Now, the question I have for all of you, do you believe the Fed is going to cut rates? Do you think that the market has a very, very different view than what maybe Jerome Powell does? Throw it down in the comment section. Let us know what you think. Now, we're going to cover a lot of the Jerome Powell talks along the CME Fed tool positions and everything like that in the debate section of the video. So timestamps all down below. So feel free to skip to any part of the video that you want. We're also going to be talking about the key levels. And yes, the key levels are going to have a bearish skew just because I am looking more bearish on the market. That's just my own personal skew on the market, just because I think that there is a severe disconnect between what the Fed has told us and what the market is pricing in. We're going to cover that extensively in the debate section. So if you really want our deeper thoughts, I highly recommend skipping to that or any of the key levels. But now we're going to go into the biggest winners and losers from market for each sector. So Fatal, take it away.
So the S&P 500 this week has just been on an absolute tear. So you guys can see on the 5-day, this thing has gone up 1.51%. You can see right here as of May 17th, we had a massive spike up, then another massive spike up as of May 18th, and then another massive spike up pretty much the same day at around 2 p.m. May 18th. But as of Friday, guys, as of 1 day ago, you can see that it has come down a significant amount, ending the day under 4,200 points. Looking into this past week's earnings, we could see here that we did have a few notable ones. When it comes to Monday, there really wasn't many, except for I would say Rumble. I mean, you know, this is the website that I put in my videos into as well. Also New, which had earnings as well. Now on Tuesday, we had Home Depot, Starbucks, and Baidu, which were again the notable ones. On Wednesday, we had Target, Cisco, TJX, and Jack in the Box. I don't really know if Jack in the Box is prominent, but nonetheless though, those are the ones that people know the most. When it comes to Thursday, this one was a big day. Alibaba, guys, I did a video on this. Make sure to check it out if you haven't. Applied Materials was another one. Walmart, that one was huge. Canadian Solar as well. And Bath and Body Works, which actually gained a significant amount, which we'll see in just 1 second. And lastly, on Friday, the only notable ones here were John Deere and Foot Locker. Nonetheless, though, these were the earnings for this past week. Looking into the 11 sectors, we could see that majority of the gains were mainly in the financials as well as the technology sector. The technology sector has just been a complete emerald this whole entire week. So let's come into these sectors and see what the biggest gainers and losers was. When it comes to the technology sector, guys, the biggest gainer, it is the company WDC, Western Digital Corporation, gaining 16%. However, take a look at this, guys. You have LRCX gaining 11.72, AMD gaining 11.09, Micron gaining 11.9. Pretty much the semis have just been on an absolute tear. Even companies over here like in the software infrastructure, Adobe 10.67, Synopsys 10.75. Guys, like, yeah, technology sector, if you were in this thing, you were most likely in the green. However, the worst performer in this whole entire sector was First Solar, losing 12.15%. Looking into the communications sector, absolute tear with majority of these companies except for a few. We can see here that Google, guys, has been, while not the best performer, has gained a whopping amount. Current price of $122.76. This company just a few months ago was, I believe it was about to go at around like $85 or so, or even sub $85. So if you bought this thing at that price, guys, you are making a lot of money right now. Nonetheless, though, not the best performer. Overall, though, the best performer in the communications sector would have to be the company Take-Two Interactive, gaining 9.72%, as well as other ones, guys, like Live Nation 8.42, and even Netflix gaining 7.5%, and even Dish gaining 8.77%. Overall, though, the worst performer would be none other than AT&T, losing 4.23%. Verizon also lost a decent amount, 4.1%, and T-Mobile lost 3.5%. When it comes into the consumer cyclicals, we can see that it's only a few companies that are massively in the green, and the best performer here would actually have to be Bath and Body Works, gaining 12.21%. Absolute tear. This is absolutely crazy. The worst performer, though, you guys can see that there were a lot of red here. At least the ones that were red were really, really deeply in the red. And the worst performer, by the looks of it, guys, would have to be the company VF Corporation, losing 10.43%. However, another notable one is Tractor Supply, 6.54% down. Nike, 4.04%. 6.53% down, Ulta 4.44%, and even Etsy 5.89%. Consumer defensives, everything here was mainly in the red. Only 2 of them, technically 4 of them, well, actually 5 of them were in the green, but the biggest green one, guys, would be Constellation Brands gaining 3.31%. Worst performer, by the looks of it, would be none other than the company over here, Newell Brands, losing 6.26%. Now, in addition to the technology sector, I did say that the financial sector was the only other one that was massively in the green. And, well, here it is, guys. You can see a lot of green here, especially when it comes to the regional banks. It's as if everything is fine. There's nothing going on anymore. Everything is good. Stocks only go up, right? Stocks only go up. But you can see that we did have a massive gains in the form of, guys, CMA 19.93%, and even I believe this one, Zion 19.35%. I think we also got a comment from Tony asking to look into Zion, because that's a massive gain overall. Other companies like we see over here, Lincoln National gaining 9.63, and also gaining double digits. We got Capital One Financial 13.42%, and even Synchrony Financial 10.86%. Massive green sector overall, with just a few plots of red. In fact, the worst performer would be Market Access Holdings, losing 4.9%. In the healthcare sector, very red sector. In fact, the reddest one that we have seen so far. Actually, no, not the reddest one, because the consumer cyclicals was by far the worst. And, well, you guys can see here that the best performer, by the looks of it, would be Catalent. This company, Catalent, for some reason, it's either like massively in the green or massively in the red. But this time, it gained 13.12%. And the worst performer, by the looks of it, guys, there was a lot. There was really a lot of them that did very bad. But the worst performer, by the looks of it, is a company, Perkin-Elmer, losing almost 10%. Also, look at this, PODD, P-O-D-D, losing 8.84%. And I do have to mention something that I really want to take a look at, guys, in a stock fundamental analysis video. The company Amgen, it is now $223.42, down 4.1%. I actually own this company, and believe it or not, it's actually near the time when I bought it. So this actually may be a good time now to revisit this company's fundamentals. When it comes into the industrials, kind of mixed. Honestly, this is by far the most mixed one that we have seen so far. And, well, by the looks of it, guys, the best performer would be the company Delta Airlines, gaining 7.1%, and the worst performer, it is none other than JB Hunt Transport, losing 4.34%. The real estate sector was mainly in the red, as you guys can see here. The best performer would be the company CBRE Group, gaining 5.72%. However, the worst performer, this is pretty much all over the place. By the looks of it, guys, it is none other than DLR, losing 6.54%. This thing is about to go sub 90 once again. I believe it only reached that for a few seconds a few weeks ago, but we are 75 cents from that. And, well, I actually really do like this company a lot, so maybe another one that we may do another fundamental analysis on. Now, the utility sector, this is the ruby when it comes to this week. Everything here was in the red, guys, except for 2 companies. We got CEG and over here, this tiny one, NRG. But CEG was the best performer, 3.07% gain, and the worst performer, this thing is just all in the red by a significant amount. And the worst performer, it is the company EIX, Edison International, losing 7.38%. But everything here, guys, is just massively in the red overall. And ironically enough, the energy sector, not that bad, honestly. Very much in the green, except for just a few companies. But, well, unfortunately for me, Chevron did lose 0.89%, but again, may present itself as a great buying opportunity. Now, when it comes into the best performer overall, it is the company EQT, gaining 8.31%, with as well as Halliburton gaining 5.45%. Now, the worst performer would be the company OKE, losing 8.16%. Looking lastly into the basic materials. Only one really lost here, and by the looks of it, there was only one very big gainer, and the gainer would be the company CE, gaining 6.54%, and the worst performer would be Newmont, losing almost 5%. All in all, guys, Yeah, it gained. I mean, it gained, and it was mainly brought up by the technology and even the financial sector. Obviously, we had issues on Friday, mainly due to the debt ceiling stallment. However, a lot can change from here to then. So with that said, that pretty much does it for this segment. Take it away, Mike.
Alright guys, so as you can see here, we basically have a clear-cut range for the next week. So our upper resistance is going to be 420, the memes write themselves, the 72, and the lower range is going to be the 410.23. So pretty massive range on the week for the S&P 500. Now I want to note something on the weekly. You see here that we are forming a RSI and MACD divergence. So the RSI is making a lower high while price is making a higher high, along with the MACD doing the same. So that's going to be crucial that we're in a price action zone. We have a wicking candle. You have a pretty good wick to the top, where on the daily is really where you see the evidence. This could be a morning star pattern where we gap up. Now, the confirmation of this candle would be that we start trading lower. So again, the market is expecting a debt ceiling resolution by Sunday. As of the time of this recording, that means you have 24 hours to resolve the debt ceiling to have a vote on the deal. I don't mean to break this to you guys, but there's no way a politician is going to vote the House, the Senate, and the Biden's desk by that time frame. They're basically bickering at one another these entire time. There's been no movement on the debt ceiling, and we just saw that in McCarthy's comments today. Again, we're going to cover that in the debate section of the video, so feel free to skip that. Now, where could the market be moving? Well, it's pretty simple that once we start breaking back below this range of consolidation that we basically had, so breaking below on SPY 415.72, I definitely would be looking for lower price depreciation. And now, again, the market is pricing in the Goldilocks scenario. When you start pricing in Goldilocks scenarios, it takes very little to disappoint you. We also had PacWest that had their debt downgraded to junk bond status. So again, for the market, you got to get above the 420.72 area to be continuation of the bullish reaction. However, you are having a divergence. You are having this Goldilocks scenario priced in. And is it really that euphoric, in my opinion? Is the market running on stable factual basis, or is it just running on people's emotions that they're a fear of missing out? In my opinion, it's the fear of missing out, and you could be creating what we thought was a head and shoulders here, but now looking at it, you could be forming left shoulder, head, right shoulder sooner. But then again, we have to see how price action works out. Anything below 415.72, that's when I'd be looking for the market to start breaking some of the structure, coming back down. And if you get down to the 410 area, then well, all bets are off. We're coming probably back down straight to the 403 area, and we just have to be very cautious once we get down there. That would be a significant decrease in the market. But then again, based on, I gotta give you guys a little bit of detail. Based on Powell's speech, the market is heading for a massive disappointment coming in June, when the Fed most likely will raise rates, which will catch 18% of the traders offsides. When you catch 18%, or correction, when you catch 60+% of traders offside, well, bad things tend to happen, or everyone runs for the door. And another thing you guys may have noticed, NASDAQ has basically been leading us this whole entire way. And I got a very interesting pattern drawn out on the NASDAQ. Just to note, you are in a reversal zone now. So the NASDAQ has the Grim Reaper signal on it, which is a strong sell signal. You have the MACD divergence that basically plays out the last three tops. So third top usually is when you break to the downside. RSI is overbought. You are in a rising wedge. Guys, this is just mayhem ready to happen. So could you break this wedge to the upside? Yes, anything is possible. But there are so many things basically telling you that I would not be betting that way, especially because you're sheerly overbought at this point. For the weekly range on the NASDAQ, we're looking at 338.82 as the upper range that we have to break, and all the way down to about the 323.96, so a massive range. Anything basically below this previous high here, 432.75, is where I'd be looking at a possible swing point, because it is a previous point that we came back above. So again, we have to see how it all plays out. Once you start breaking that level, then I'd be looking for possibly this 320, 330 area to be retested, which is the bottom of this ascending wedge. If at that point we get down to these prices, I do see the MACD curling over, and this is where it starts to get scary, because everyone's going to say, oh, we're going to bounce, we're going to bounce. If you break this upper trend line, you have no support between the break of this trend line, which I think will occur at around the 326 area, all the way down to at least the 315 area. That's about a 4 to 5% sell off. So if you think that carnage won't create massive carnage in S&P and NASDAQ, well, I have another thing coming for you, and again, an island to sell you in the Bahamas. So again, with all that said, those are the ranges that we have to basically be looking at. If a break above 338.21 and the market just continues upwards, then, well, the euphoria is really going to be real. Would I be buying at this level? Absolutely not, because of all the bearish signals. And we could trade sideways because this has been a massive move. We could trade sideways, but again, I've been expecting a trap set in the market. I'll personally admit that I was not expecting on the S&P and the NASDAQ to rip up like this. I thought the S&P would stay range bound. NASDAQ kind of just was doing its own thing. But again, you learn from your mistakes. So with that, just to recap, 420.72 is the upper region for the S&P, 410.23 for the downwards range for the S&P, and the NASDAQ, we're going to be looking at 338.21 and then 326.92 as the range that we want to see for next week. And now, guys, I'm going to go into something new that I want to try out. I'm going to pull up a chart of the open interest for the NASDAQ Friday expiration option. So basically, we can see what the expected range for the NASDAQ is and where market makers could be setting up for positioning and how people are positioning. So taking a look at the call and put option open interest for May 26, which is another week for the S&P 500, we can clearly see that the range is more skewed to the downside. You have a lot of very expensive, I would say, positions that are up above 418. So the market traditionally will not try to push up to that area if market makers are trying to basically create max pain. Max pain, in my opinion, right now is sitting right around 417, which would be the expected move for the market. You have a lot of put volume sitting here on the lower side and a lot of call volume on the upper side, so basically just burning all of that. Now, if you were to extend past the 1 standard deviation move, you do have more calls to burn per se than puts on the 1 standard deviation move. But again, it's pretty equal once you start getting to that 1 standard deviation point. So the market could move either way. I would say that it would skew to the upper side versus to the downside for a burning perspective. So we could probably just see a sideways range bound market this week if I was looking at the options market to see what it was pricing in. So now we're going to jump over to my most favorite indicator, the VIX, dollar, and yields. So the VIX today, or on Friday, was basically trading almost green. It was very interesting. If we go into the 5-minute, you can clearly see where Jerome Powell started to talk. And I'm going to give everyone one guess, and it's pretty much square right here. If you guessed that, pat yourself on the back, because it was pretty impressive. The second he started talking, boom, right up with the VIX. Everyone, fear and greed going to the roof. So looking at this, VIX definitely has the potential to have a spike from here. The MACD is trying to curl back up above itself. RSI still above that 50 line. So you have the bullish price action there and the strength. Now you just need to get that breath into the market. MACD has the ability to push that, along with some of the things that are happening with the debt ceiling negotiation and Powell's talks. To me, I see VIX forming a base around here and wanting to go higher. And notice how VIX really didn't get pushed down significantly from where it was to the close of the week. It only got a 6% push down. Now, the interesting thing is VIX was up 4.74% with the market only being down barely anything. So that means there is true fear left in the market, and we saw the net speculative positions. If they're shorting the market, they're definitely having put buying. So they basically want to juice their puts using the implied volatility. So VIX to me is showing a very bearish sign that it's the sleeping dragon that you don't want to wake up, and the dragon is waking up. So I would definitely keep an eye on that. We could get a volatility spike easily up into the 20s and 30s this week, especially if the debt ceiling carnage really starts to unfold. Looking at the dollar, this is the other peculiar thing. The dollar this week was gaining strength, guys. It's above its 50 daily moving average, just pounding higher, which is very weird considering that the Fed is going to cut rates. So again, the dollar and the bond market is basically telling you the Fed is not going to cut rates. It's gaining strength again once this long-term rate increase project that the Fed has embarked on is still going strong, where the market's expectations are basically incorrect, as I would say. So the dollar forming a higher low, higher low, higher low here. So then now we need to see if it forms a higher high. Now that higher high would occur at the 105 point, and yes, one day of red doesn't necessarily mean that we get a downwards draw on the dollar, but then again, the MACD is separated from one another, but we do have a sell signal on the dollar, so we may see a pullback in the dollar, we may not, we may just invalidate the signal. Remember guys, it's just a signal. It doesn't necessarily mean that it always comes true, but it has a high probability for it depending on how you trade it. So dollar pushing up higher. If we look at the weekly on the dollar, we can clearly see that the MACD is trying to pinch together to push up higher. Could we get a resurgence in the Fed's efforts to basically push up higher? Well, time will only tell. Now, if the dollar gains strength, the market is going to weaken. So again, we have to be very cautious of that. And one thing I really want to point out is the 1 month yield. The 1 month yield has crossed bullish on the weekly. The MACD has crossed. RSI is trying to get above that 50 line, and the daily is showing strength as well, where the MACD could start curling up. The RSI is showing extreme strength. So again, if the 1 month is showing strength and we have a Fed meeting that's basically going to say we're going to pause, and this yield is higher than the current federal funds rate, why would that indicate a pause? The bond market, which is massively bigger than the stock market, is telling you the pause is BS. Now, the 3 month and the 6 month have not priced this in yet, so we do have to see. The 3 month and 6 month are still pricing in cuts, or basically a decrease in rates, kind of floating around, tiptoeing in between both of them. The 3 months sitting at 5.2%, along with the 6 months sitting at 5.12, which is lower than the federal funds rate, but it's still within that range of the federal funds rate. So kind of askew, and like I said, a tippy toe in between one market or the other. So we just have to be careful of that. Now, with all this summed up together, the market is basically showing strength, but maybe a false strength of security, especially just quickly jumping to KRE. KRE on the day the market pushed down was down 1.78%. To me, what I'm seeing is we have a push up, a slam down, push up, possibly going to get another slam down. If KRE starts to roll over on the MACD, we definitely could see more carnage in the market. RSI is not really showing much strength, sitting at 53. And now, if the MACD gets above the zero line here, then yes, we could show strength. But if it starts sliding back down, the Neo Cloud is showing that you are in a bearish area. So we really have to see, are the debt ceilings going to create pressure on the regional banks, and everyone's going to basically flight from the financial sector? Is Warren Buffett's basic premise of the entire financial sector not being a buy right now going to come true? Only time will tell. Now, let's quickly jump into the next week's news just to see what catalysts we could be having coming up, excluding obviously the debt ceiling that's going to be next week. Let's see what we got on deck. So looking at Monday, we have Bullard, Barkin, and Bostic speaking. If last week wasn't a Fed overloading, we got 3 more Fed members speaking. So, oh boy, this is going to be fun. So I wonder what carnage they could come up with in the market, especially Bostic and Barkin, which are voting members this week. Bullard, I don't understand why people react to what he says, but apparently they have had so much fear being into them by him. It's just very fascinating that how the market reacts. Tuesday, we got building permits coming in along with new home sales. So it's going to be interesting to see if housing inflation is possibly coming down, where you would expect to see less home sales than new home sales. They're expecting about a 20K decrease in new home sales, and on building permits to decrease about 15 million expected building permits to decrease. So you're expecting to see some decreasing in the overall housing market, but not too tremendous. On Wednesday, we pretty much have the standard, but we do have FOMC meeting minutes coming out on Wednesday here, where that will be in the indication of the Fed meeting, kind of laying into that as well. Along, we have Treasury Secretary Yellen speaking, probably going to be talking about the debt ceiling, and I do suspect the debt ceiling is going to take precedence up until Wednesday, where we get the Fed meeting minutes, which in my perception is going to be that most participants did not agree on a pause, that they saw maybe a pause in the future would be what was expected, basically destroying the market's expectation. Again, the market is setting itself for failure. On Thursday, we have core PCE. So this is the Fed's preferred metric, along with preliminary GDP quarter over quarter. So they're expecting a 1.1 growth. Previously, it was basically non-existent growth, or they were expecting 2. So again, if this preliminary gets revised lower, it definitely could be very, very tremendous for the market. And we have initial jobless claims coming in. They're expecting an increase in that. But again, they've missed every single time. Pending home sales coming in, last time was negative 5%. Now they're expecting a positive 0.5, so maybe a dead cat bounce in that. But overall, the big hooba is going to be the GDP and core PCE prices, so on Friday is when we get the actual PCE numbers. So that's the Fed's preferred metric again. The PCE prices just kind of tell us what we're going to be seeing. So we get core durable good orders as well, which is going to come in. We have core PCE price expected to stay flat. Year over year expected to stay flat. This is setting up to be a very bad narrative, guys. And then PCE price index, the month over month number, is expected to increase on personal income and personal spending. So this number just doesn't look well for the market. That doesn't play into the narrative that inflation is coming, and especially with Jerome Powell's comments of inflation is going to take time to come down. It definitely kind of gives credence to his thoughts here, especially looking at history. And then again, we get the net speculative positions. But with that, guys, we're going to dive into the debate section now. So feel free to minimize the video, where it's just going to be a talking head piece of it. We're not really going to be showing too much. But again, thank you all for watching so far. If you like the content so far, do hit the like button. It really helps the YouTube algorithm. And throw a comment of what you may want to see us cover in future videos. We always like to hear your feedback. So without further ado, let's get into the debate section. All right, so first off, I want to start with your reaction to Powell's comments today, because, he spoke at 11 o'clock with Ben Bernanke, which was the Federal Reserve Chair during the 2008 financial crisis. And there was a couple things that came out of that I think the market basically has hearing problems or something, because they're just on a different planet at this point. And they're high on like Breaking Bad drugs.
Oh, yeah?
So
those gotta be some good stuff then.
Oh yeah, that's pure crystal meth. But
I mean, for God's sakes, they've been on this pivot narrative for more than a year and a half.
It gets better. It gets really better. So Fed Powell, recently markets have been pricing in a different right path.
They've been doing that for like a year and a half, man.
Yeah.
I like how now he's pointing this out now of all.
I think for him, he's just looking at it and being like, You guys really are running it up on this? He's probably debating in his head how blunt he has to be.
Dude, you guys are really running it up because we put an extra space on a comma on the 72nd page of the FOMC meeting.
Probably.
Like that's thinking like that's pretty much what he's saying there.
He honestly actually commented in this one. That seems to reflect a different forecast of inflation coming down more quickly. This was in the same sentence, one after the other. And he's basically saying like, guys, no, just no.
So about that, I actually recently found out something very, very interesting. In regards to the headline inflation, so the one that we get, inflation's down to 5%, inflation's down to 4.9%. So the highest inflation rate that we got when it came to the headline inflation, it was around like 9%, 9.1, right? Mm-hmm. And right now, as of April, I'm looking at it right now, it is 4.9%. So that's a massive drop, right? And that's what people look at when the inflation number comes out. Oh my God, the headline inflation. Fed, though, takes a look at what? Core inflation and PCE, right?
Correct.
And it's actually interesting because I recently found this out. So inflation at its peak, headline inflation, went from 9% all the way down to now of 4.9%. That's a massive drop, okay? Yeah. We can both agree on that.
Yes.
Okay. Core inflation, when it was at 9%, you know what that was?
Probably 7. What?
It's like 5.9%, 6.
So basically, it's stagnating.
It's literally not fallen at all. Like I recently found that out. It's literally not fallen at all.
Which is perfectly in line with his comment. He said here, so far, data appears to support the committee's view that lowering inflation will take time.
Yep. Because again, they're not looking at the headline inflation. They're looking at core inflation and PCE and, of course, job numbers as well. Job numbers and unemployment. Which, by the way, that has been leaning... Oh, did he say something about that too?
He did mention it. I'm not 100% sure that as he reiterates, market pat differs from Fed's forecast.
Right.
So he basically talks about policy stances, maybe not is restrictive or slightly restrictive, but they haven't really made a decision about how much firming may be appropriate. And then he leaves the door. Fed was expecting further tightening until recently, which now that's basically...
Fed was expecting further tightening until recently?
So
tightening of what? Like
tightening of monetary policy, so continued tightening. I think when he views tightening,
so QT or what's it called? Quantitative, QT, quantitative tightening.
So when I think in his view is the aggressiveness. I think what he refers to tightening, he's referring to being very aggressive. In their mind, 25 basis points is not aggressive. In his mind, that's basically
it's a softball.
Yeah, it's just making sure he doesn't. He also, so this obviously is not going to have all the comments that he had when there's two main points. So he continuously cites the 1970s, where talking about how inflation came down and then was resurged again because they didn't do enough. He also references that he doesn't want to repeat. This is where, if you study how Powell learned, he studied the 1970s. He studied Volcker's the 1970s. He fears
80s.
repeating
80s.
Yeah,
80s.
1980s. So he fears repeating that same legacy where Volcker tightened very quickly. AKA Powell didn't tighten quickly. And Volcker loosened policy rather
almost
quickly
immediately
after tightening.
Yes. And then right after that, you see a massive spike of inflation once again, and then they had to bring it right back up to then quash it back down again.
Which
I remember that graph.
So basically, with that, you hurt the economy severely. Powell fears this. He openly talks about this. He continuously mentions Volcker's 1980s. So he's trying not to repeat the mistakes that his, I guess you can say, predecessor or someone that he studied and learned or basically bases his whole entire monetary policy off of and judgment. He's trying not to repeat those mistakes.
Right.
And he mentioned, he was asked directly, and I don't know if you can consider this, he walked around this or he didn't really walk around this. He was asked about the jobs market. And so he was asked directly, and I mean directly, do you believe that the jobs market has to, can remain tight and inflation come down, or do you believe that they are not mutually exclusive to one another?
Okay.
And he basically flat out came out of the gate storming and said, no, they're not mutually exclusive. History has taught us that you need slack in the labor market, and the jobs data will be very key in our fight against inflation.
And right now, what have we been seeing when it comes to the job numbers and even unemployment, right?
Yep.
Beating expectations every single time. Now, granted, beating expectations doesn't really tell us much, right? Because, I mean, it's what people think that it'll be, right? It's what markets think that it'll be. But think about that. If you're expecting 200,000 jobs, right? 200,000 jobs for the month of whatever, and it comes in, at 400,000 or 500,000, you're the Fed and you're just like, man, unemployment just went down again? Oh my God, we need to get more people laid off. We need to destroy people's jobs.
We need to destroy their ability to create inflation.
We need to create, wow, that's a way to say it. Say it again.
That we need to destroy their ability to create inflation. That's what they view it as.
Meaning we need to destroy their ability to live. Yeah. That's literally what he's saying. That's
literally what he's saying. Actually, the comments.
That to me is ridiculous.
The labor market slack did not figure into early inflation, but I do think labor slack will be a factor in inflation going forward.
Meaning 100%. What do you mean going forward? It's always been a metric.
Yeah, but they're going to twist that metric left and right.
That's just, oh my God. Oh my Lord. All right, well, that's what the Fed said. Unfortunately, I couldn't catch it because I was busy at work. But man, that would have I would have just been pulling my hair. The little hair that I have left, I would have pulled it.
It was it was honestly a very interesting conversation, and it did show, and I'll give praise to Powell of how well he can walk the line and drop hints. He was you can see where he was trying to get the message across of if you were listening hard enough to give you insight of what they're going to do. And the market basically did 180. So during this, Fed swaps downgrade June hike odds after debt limit talks stall.
So can I ask you a question? Hang on, before we move on. Can I ask you a question?
Sure.
How did the market react to this? Do they still think that we're going to get a pivot?
No. They topped it. They topped my expectations.
Go on.
So we're going to have this link down in the description. I got to start going over this in the live streams, and we're going to be covering this. I did find this tool. It's been out for a while, but this is the first time I found it. It's called the CME Fed Watch tool. This basically tracks their next meeting.
Wait. What is this from though? Because I've never.
So this is polling. So this is actually from the CME group, which is one of the indexes.
Yep.
So the CME index polls economists and different people to understand what their perception of the Fed hikes. So going into the latest CPI, we had a 4% chance of a Fed hike in the next meeting. Going into Powell talking today, I'm going to zoom in, and I'm basically going to try. I love how it doesn't. But this right here is the day one, May 18th. Basically, at the beginning of the market, you had a 64% chance that the Fed would pause in their next meeting, and a 35% chance that they would hike in the next meeting, a 0% chance of a cut. Now, we have an 81% chance of a pause and an 18% chance of a cut. 18% chance of a hike. So, therefore, the market said, because debt ceiling is falling apart, then therefore Fed must cut or not raise. And I'm just like, what?
So they're still on the pivot narrative then.
Yes, they are setting themselves up, in my opinion, for
the
biggest rug pull ever.
Literally just came out saying, you people are stupid. What in the world are you doing thinking that we're going to our inflation target? What? Yeah. That's pretty much what he said. And wait. Go back to that. Hang on a minute. Let me see. So let's see. Target rate BPS. So the current one, it is that's a target rate. Okay.
Yeah, so it's basically their current.
All right, scroll down. So I want to see this. So as of 1 day ago, they thought that it was going to stay. So 64.4% believed that was going to stay. That wasn't going to go up or down.
Pivot.
36% or 35.6% thought that it was going to get increased from between 525 to 550. Right?
Yep.
That's if I'm reading that correctly.
Yes.
Today, today after the
This
whole
morning.
debt ceiling, right? After the whole debt ceiling negotiations stalled out, which by the way, that did happen. We're going to cover that in just 1 second. And the Fed coming and Jerome Powell saying like, yo, we need to continue doing this. I don't know what you're thinking. More people believe of a pause now?
Yes, because, you know, we got to kill every brain cell we have. And
My brain cells are dying just reading that.
I love this comment.
It's
the definition of insanity. I think I can say that now. Doing the same thing and expecting a different result after the man told you the market rate path differs from the Fed's forecast.
Dude, they have been saying this.
I think he knew this was going to happen.
They have been thinking this for like a year and a half now. Like, it's just absolutely insane. Like, the whole pivot narrative started the second they started increasing interest rates.
Yep. And you know what's the worst part? And I covered this in the beginning of the video, that I thought these shorts would relent. Would you care to know what the net speculative positions are borderlining on?
Go on.
Now, mind you, before this massive pump, there were 376,000 positions net short.
Before this massive pump, you mean as of Thursday, right?
Correct.
Because, I mean, today it went down.
So they publish it every Friday. So as of Monday,
okay.
So remember, the big push, remember, they're shorting the market.
Right.
Would you care to know what that number... So you would think that them shorting the market, this massive push, shorts would capitulate.
Yeah, absolutely.
Do you know what we're borderlining on now? We were 376.
Are you telling me that the shorts didn't...
No.
the massive pump, shorts did not capitulate, but they increased it?
Yes.
So
To
the short interest
388,000.
On what? S&P?
Yes. The S&P is now more short than the dot-com bubble. So here we have the previous with 376,000 net short. Now you're 388.7, and this is published by the CFTC data. So this is basically a I'm not going to say a fund. It's a institution that basically looks at the S&P short positions, and they've been publishing the data on and off. When we were going back through beginning of January, they really didn't publish it just because they were losing per se. But now it's basically, well, you know, this a lot of people cited.
Look at that graph, though. Oh my God, look at that graph.
So it either one of two things, and this is, I'm not discounting one of them. That either a lot of smart people are really, really, really dumb, or a lot of smart people are really, really smart.
So hang on a minute. Let me stop this. So you see how some years you have it in the positive?
Correct.
So again, I don't really short. I'm not a fan of shorting. You do it more than me. Explain to me what is the difference when it's in the positive and as opposed to now being in the negative.
So this is the summation of all the positions on the S&P 500. So when it's positive, that means there's more people long the S&P versus shorting. And so
okay, that means okay.
Yeah,
Got you.
so they put on this short position back in June. So, you know, for Jerome Powell's Jackson Hole speech marked the start of the short position. And through it, they've been on, off, around the 150. And then going into recently, probably since March, since the last Fed summary of economic projection meeting, they have just been there was no relenting. Every time they take some off, they add on. And I honestly thought, and this is my honest opinion, I thought I was going to see 350, 320 today. I thought I would see a 50,000.
You thought it was going to come down.
Well, because the thing is, the market basically just wrecked their entire position. Like it's a pain trade, but they're literally adding more. So either there's a lot of dumb people that made a lot of money previously, or someone knows something that just does. Like, I've heard people that trade in 08, and this is what I'm seeing that scares the daylights out of me, is this. Why is VIX this green when the market was barely red?
This is fixed on what?
A daily
5
chart.
minute on a daily chart.
So
okay.
VIX came back down to the last time it ripped your face off. So now it had a green day. So
what is VIX at right now?
VIX right now is at $16.81, which hasn't really, you haven't seen VIX be this low going all the way back to 2019.
Okay.
So I wanted to show you the intraday. I'm going to give you a guess. When Powell started talking.
I can already. Is it the
And I
one,
do
two?
not, and I kid you not, I'm gonna go to the 5 minute. We're gonna make this really fun.
Is it the?
I'm gonna look at the time. Going into it, there's some, people are buying some risk. Look at this first candle. 11 o'clock.
Look at that engulfing
Bink.
candle. Look at that. Oh my god! How many,
literally,
how many
11 o'clock hit.
There's three engulfing candlesticks to the upside, like instantly.
Yeah, 3 white
Wow.
soldiers. Bloomp.
Wow. So what happened to the S&P at the same time frame?
So we can go to the S&P at the same
Yep,
time
go
frame.
to the S&P for the
And
same time frame.
so it actually S&P was kind of trending down into Powell a little
Yeah.
bit, and then Powell comes out, opens his mouth, and it's like, oh crap.
Instant collapse. No,
Well-
I wouldn't say it was falling to begin with. It was more like stagnant. It was catching its footing, and then as soon as Powell just started talking, it's just like it's like an inverse of the VIX.
Yep. Oh, which they are inversely correlated.
Oh
However,
yeah, of course.
I do look at VIX a lot more than you. VIX
Yeah,
being up
I don't look at
4.7% when the Nasdaq and S&P are only down 0.25 is a very large divergence. Usually it's
Yeah.
about 1 to 2% at the max. Like 2% is really stretching it, whereas it was up 6.5% one time during the day, and I was
VIX.
basically like when
VIX was up 6% on the day.
nearly
Okay.
7.
Okay.
So like the peak from basically bottom to peak, it was up about almost 8%.
Okay.
But take some rounding error there. Let's say 7. So VIX is up 7% when the market's barely down. So what that means is people are buying insurance. Why would you be buying insurance? Maybe it's because of this. McCarthy, when asked about the debt ceiling talks, pause. We've got to get more movement from the White House, and we don't have any movement yet. But I thought a deal was incoming Sunday.
And what's hilarious is no. What's even more hilarious than that is anybody who believed, and if you believe this and you're watching this, I'm so sorry. I don't mean to be rude, but man, if you believed that these negotiations when it comes to the debt ceiling was going to go smoothly, bruh, where do you live?
I got a
It
Fed
ain't the
pivot
US.
to sell you.
Hang on. It ain't the US. You know why? We just went through, I think it was what, like 10 rounds or like 8 rounds of voting for the Speaker of the House. And that was Republicans voting for the Republican Speaker. So you're telling me that it was going to go smoothly? No way, dude. I would not be surprised if the government shuts down because we're at a stalemate like we did. I think this was back in like, what, 2016, 2017?
Let me throw some more spice into the mix.
Go on.
House Democrats have now completely coalesced together, not a single dissenter, saying that they will not vote a single measure of spending cuts without passing a clean spending bill, meaning McCarthy is stuck with the people that gave him his voting or his speakership. So he's got no avenue to go left.
With the people that are like, you step on the line. You step on the line and you're canned. Got it, old man. Like that's pretty much what they're saying.
So not only do you have to contend with satisfying the Democrats in the Senate, not only do you have to contend with satisfying Biden, you have to now contend with your own party ripping you to shreds, and possibly
not even your own party. Not even your own party. I would say a branch, an offshoot branch of your party.
Correct, because they need the 16. MAGA or whatever someone wants to call them, group, Freedom Caucus.
MAGA. The MAGA side of the Republican Party.
That want to basically have extreme amount of spending cuts. When they were voting the initial bill, remember McCarthy passed an initial bill, there was dissenters. The Democrats came across the aisle, and you had a couple that came across the aisle to basically help push it through. But again, they did take advantage of some of those MAGA Republicans being absent, meaning their vote necessarily didn't count, and they lowered the threshold. So here's the thing. Fool me once, shame on you. Fool me twice, shame on me. So now those are going to be present in DC and basically live in the Capitol, so you can't pull that shenanigan again.
Yeah, it's gonna be interesting. And again, it's whatever side people are in. The fact of the matter is, if you believed that this was going to go smoothly, again, I don't know what world you live in. I really don't. Because, I'm not going to get political here, but we have seen the bifurcation happen even more and more and more. It's not going to be better, guys. It's not going to be smooth talks.
Name one time in history a politician did something right.
Well, they're a politician. They're not supposed to do anything right.
Yeah, that's their job description.
That's the way that it is. All of them. Every single one of them. So it'll be very, very interesting. It'll be very, very interesting to see what happens. Because, again, we thought that they were going to get a deal by Sunday.
Yep.
Well, it's the end of Friday as we were recording this, going into now Saturday, and I don't know. I highly doubt it. I highly doubt it. And even if they do, guess what? They have to pass through the MAGA party of the Republican Party, like the Matt Gaetz, the Chip Roys, the Lauren Boeberts, etc., etc., etc. So that's gonna be interesting.
And then even after all the rhetoric of, well, the White House isn't really moving on anything, then they say, McCarthy on the debt ceiling, we will be back in the room tonight. Okay, so you're going to be back in the room that you couldn't get anything done for the past 3 days to then do nothing again. I'm like, the market on close believed that they're going to still get a debt ceiling resolution by Sunday, guys.
Listen, man. The market is believing that. A pivot will happen, that a pause will happen. Everything is fine. I don't know why you're complaining. Everything is fine.
I'm going to get my rug pulled. That's all I'm going to say is Jim Cramer said everything's fine, so...
Jim Cramer said that right now the U.S. dollar is nice and strong.
Yep.
If anybody doesn't know his reputation...
Which he is right about that. The dollar is gaining strength.
Sure.
Broken clock,
but we all know his
today.
reputation. Yeah, but we all know his reputation. We're talking about the guy that said Lehman Brothers is a buy, Bear Stearns is a buy.
Don't forget SVB and FRC.
SVB and SRE, yep. Them too. And, we know what happened with those. So
hey, a broken
it'll be very,
clock
very
is right twice a day.
Yeah, unless it has his two hands missing. You didn't say how broken it had to be, buddy.
Fair enough.
You didn't say how broken it had to be. So there you go.
And also, the other question I have is, not getting into the politics of it, but McCarthy, and there's been a lot of talk about the 14th Amendment and as a workaround for the debt ceiling and all this. I'm like, what? And you got Democrats that are encouraging it. You got Senate Democrats that are encouraging it. Like, what happens if they start to try leaning towards that solution and they just create a bigger mess?
Actually, let's go on. Let's talk for real. Right now is between the legislature and the executive branch, right? They bring in the 14th Amendment. They might bring in the judicial branch too. You think the courts are going to allow it? Yeah, you think the courts are going? You think people won't litigate it at that point? I think the 14th Amendment is the one for taxation, if I'm not mistaken.
Or something around that nature. But regardless, it's like you want to throw more things into the stew that's already complicated.
Let me see. 14th. Oh, no. 14th Amendment. This is what I don't understand either. Janet Yellen mentioned this, and I think I mentioned this as well on the video I did on last Friday. The 14th Amendment has to do with naturalization and citizenship.
Yeah, that's why when I looked it up, I never understood it.
I don't understand as to why they're bringing this in. I really don't. So that's, I don't know. I guess maybe under protection, but I'm not really sure.
Speaking of our good friend Janet Yellen.
Oh, I heard she said something today. Yes, she said something today about the banks.
I
saw that. Yes.
So U.S. Treasury Secretary Yellen told bank CEOs more mergers may be necessary.
Wait a minute. Isn't that what I said a few weeks ago?
An engineered collapse?
No. What did I say a few weeks ago? This is almost looking like a merger. This is almost looking like a forced merger without having to go through the legal system.
Yep.
It's almost like the big banks want these tiny banks to fall because then they'll gobble them up, taking out the competition, acquiring them without having to go through the legal system of it. And she just proved it right there. Why did she use that word merger?
Because it's a merger.
Because it is a merger. This is what I'm thinking, man. Like I think that this whole banking collapse with the regional banks is a way to straight up fuse the big banks with the little banks to only have 6 banks in the United States. Like if it wasn't, why did she just use the word merger?
Well, not even that. Talking about PacWest just for a second, their debt got downgraded to junk bond status.
I heard that as well.
So
yes.
now their lending cost their borrowing cost is going to increase.
Skyrocket. Yeah.
So now they can't take advantage of the Fed discount window. So they're completely knocked out of that. So how long do you think a floundering bank that was basically being held to pieces together with the Fed discount window, essentially, that no longer has access to it, is going to last?
Right. 2 weeks, maybe.
Yeah, I give it till Tuesday.
Okay, till Tuesday, the weekend essentially.
Yeah.
But anyways, guys, I think that's pretty much all we really wanted to talk about. Anything else you got?
One last thing, and then we'll wrap it up.
Sure, go on.
You think this is gonna go pull back anytime soon?
So the funny thing about this is when we did the live stream, this fear and greed index was at neutral.
Yep.
And that was, I believe, last week.
Yep.
7 days later, we're almost at near extreme greed.
We nearly
What
touched. We were at
changed?
69 this morning.
What changed? There's not. Why?
Everything's fine.
There's no
Fed
rhyme or reason.
pivot.
Everything is fine. You're right.
Fed
You're right.
pivot, debt ceiling resolution by Sunday. Don't worry.
You're right. I forgot that everything was fine. I completely forgot. I'm so sorry. But anyways, guys, I think that'll pretty much do it for this video. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. Y'all can follow us on the music sites. Link is in the description below. So with that said, peace out, and we'll see you all next time.